The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Financial markets taking their cues from the energy sector as the U.S. war with Iran continues to escalate. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking off the closing bell here in the U.S., the S&P 500 not quite at session lows, but pretty close, down about 1.2%. A lot of the pain trade coming through when it comes to the chip makers right now, the chip stocks in general. The Philadelphia Semiconductor Index down about 2.7%. Bloomberg broke the news a little bit earlier today that the U.S. is considering requiring permits for sales of chips from the likes of NVIDIA, from AMD. You can see the reaction in markets right now, not sending a haven bid into the U.S. bond market. 10-year Treasury yields higher by about 5 basis points right now. We're back above 410. All of this sending volatility through the equity market as measured by the VIX. 4 vol points higher right now. We're back trading with a 25 handle, Romaine.
Yeah, keep a close eye on the S&P 500 because we're going to try to see if the dip buyers are willing to come back in this final hour of trading. It's not looking good as the drip of headlines coming out of the Middle East continuing to put upward pressure on oil and gas prices. WTI closing above $81 a barrel. That's putting upward pressure on government bond yields, which is putting downward pressure on equities. Volatility complicating the economic picture and complicating the calculus for the Fed.
I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short term or long term. And so we'll just see where it goes.
Now, so far, the economic data, numbers largely collected before the outbreak of the war, that's still pointing to stability. But there is a monthly report from the government due tomorrow on U.S. payrolls that is expected to show tepid job growth in February, though many economists attributing the likely weak print to temporary factors like labor strikes and bad weather. For now, keep an eye on travel stocks. They continue to bear the most severe brunt of the equity sell-off. Hilton down a second day, United Airlines down a fifth. Norwegian Cruise now headed towards its worst week since last April. Also keep an eye on apparel importers, as a couple of which have already cited supply chain disruptions. And in just about an hour, we're going to hear from another, Gap, set to report earnings after the bell.
Yeah, looking forward to breaking down those numbers right here on the close. But let's take stock of what we're seeing when it comes to the equal weight S&P 500. It's sort of been the darling of this market because the large cap, or rather the market cap weighted S&P 500, it's gone nowhere over the past few months. You can see over that time, the S&P equal weight has built a nice rally, but then you take a look at the past 5 days. That's that bar there in the bottom. The past 5 days, that is the biggest drop that we've seen on a rolling basis since about November. So that rotation trade that has really benefited the equal weight and even some of the small caps as well remain starting to turn here as we digest, of course, what we're seeing on the geopolitical front and what that has meant for the bond market. Rates have been sent higher. That hasn't been good news for this broadening out trade.
And interesting to see the correlation start to pick back up. Venu Krishna joins us here in Studio 2, head of U.S. equity strategy and global equity linked strategies at Barclays. Venu, great to see you again here. We've gone through these geopolitical issues from time to time in the past, and the general narrative, at least historically, is that the read-through, or the feed-through, I should say, into equities usually does not matter longer term, that we get the knee-jerk reactions, but eventually things sort out. Is there any reason to think that this time would be different?
I think so. I think the risk this time is slightly higher. Mm-hmm. So what you painted is the historical experience, at least in the last 5-6 years, where most of the conflicts have been contained, especially geographically. I think what is different about this conflict is already it has expanded beyond a very narrow target. So I wouldn't, it's difficult to say whether this expands or not, because the existing regime in Iran is already very weak. And it's relatively one-sided in terms of what's happening. But still, I think the risk that it spreads more, affects the oil markets, affects the whole of Middle East in terms of what's going on, does create this risk, which, by the way, is not being priced with the markets. The market is behaving as if this is going to be contained, and we very quickly normalize.
Yeah, it's kind of interesting, too. I mean, today's a little different, but the last couple of days, you kind of see people come in and start to buy the dip. It's also interesting, though, to see what kind of the direct correlation, at least on the Bloomberg screen, between what Katie was kind of pointing out, that as we see energy prices drift higher, yields drift higher, and then, of course, that means we start to see a drop in stocks. What is that telling us?
Yeah, I think you got to watch oil right now. And already the rates market is repricing the cuts, we assume, this year. And already the concern is about the inflationary impact on one hand, while there's a camp which is more constructive on inflation that it comes down, and that is at risk as well. And even if you look at oil prices, the reason why it's a little mixed is that the outperformance of the oil sector is a little extended because fundamentally it is very difficult to justify where the oil prices are right now. If you look at the historical relationship between where the WTI or the oil prices versus where the prices are, it's already factoring in a $100 oil price, which I think is a stretch at this point where we are closer to 80. Similarly, oil valuations are extended unless you think the strip reprices higher, which means greater earnings. But based on what we know today, even valuations have become extended for the energy sector. So I think there is a real risk over there.
Yeah, and one of the headlines that we got today, the hot headlines on the Bloomberg terminal, that when you take a look at U.S. oil, where it's pricing, topping $80 a barrel for the first time since January 2025. And then, of course, there's what's going on with Brent. But where does this leave energy equities? Because for a lot of folks, the knee-jerk reaction was, okay, I'm going to buy energy stocks. Sounds like what you're saying when it comes to the actual underlying market there, what's going on with oil, maybe that's not necessarily the trade going forward.
Yeah, so I think the challenge is this, and we admit this very clearly recently in our research, that on one hand, we are quite confident when we say that they're outrunning fundamentals right now, the energy, but it's also difficult to fight the tape because the energy sector in the last 3 years has seen pretty significant outflows of cash. But more recently, in the last 8 weeks, we've had the strongest inflows in quite some time. And if you look at the amount of outflows of what has come in, there is a lot of room to catch up. So that's why, to the extent that money keeps gravitating towards this sector, which, by the way, whose weight has collapsed in the S&P to quite low levels in the 3% range, I think it's difficult to stick to a fundamental argument which says that, it's perhaps overshot to an expectation that oil will remain high for a sustained period of time, which is possible if this conflict extends significantly, but we don't know.
And I do want to talk about what this means for the rest of the world, but specifically Europe, because, the conversations that Romain and I have had this week is that this conflict that we're seeing in the Middle East, what's happening with some of these energy prices, will be much more acutely felt in Europe relative to the United States. And you put that in the context of the fact that, European stocks over varying time periods have been outperforming U.S. equities. Could this episode sort of throw a wrench in that?
Absolutely. In fact, that is the trade we recommended just this week, both in the cash markets, which from a strategy perspective, in the derivatives market as well. Because the U.S., remember, is a net exporter of oil. And the big scheme of things, we are relatively immune, both geographically and in terms of our dependence on oil and gas. It's exactly the opposite for Europe. So not only has their economic growth been relatively weaker than the U.S., they're a lot more dependent both on oil and gas. And in fact, gas, they just moved away from the dependency on Russia to a greater dependency on the Middle East. So it's from into the frying pan. So we absolutely agree. And many ways to express it. You express it in the U.S. outperformance versus Europe. You express it in the derivatives market, buying protection, especially in Europe. And what's interesting, if you look at valuations, what has happened so far this year, U.S. actually right now looks a lot more attractive. On a 5-year look-back basis, the U.S. right now is trading at around 57th percentile of their history. Europe is in the 90th percentile. So that tells you that the valuation argument, which was what helped Europe outperform for the last year or so, is actually has dissipated.
All right, Venu, great stuff. Venu Krishna is head of U.S. equity strategy and global equity linked strategies over at Barclays. A closer look at some of those energy stocks. And when we come back, a deeper dive into the energy landscape. Former U.S. Energy Secretary Ernest Moniz is going to be joining us in just a minute.
And then we'll pivot to the other market driver, retailers. Mickey Drexler, he is the chairman of Alex Mill, also the former CEO of J. Crew. He gives us the bird's eye view of the American consumer, plus what he thinks the winning and losing trends are in the sector.
And from a legend in the retail space to a legend on the basketball court, a conversation with Scottie Pippen set to auction off a slew of memorabilia over at Sotheby's. Don't miss that conversation and more coming up right here on Bloomberg.
Well, we've we've had a big week of economic data, and it culminates tomorrow in that jobs report, also retail sales figures. Now, what looks to be a stabilizing economy hanging in the balance, with Wall Street estimating 55,000 job additions in February. Let's discuss with Mark Zandi. He is chief economist over at Moody's Analytics. And let's start with that jobs report that we're getting at 8:30 a.m. tomorrow. You take a look at some of the labor data that we've gotten so far this week. Claims most recently coming in a little bit lighter than expected. How does that set us up for tomorrow's report?
Well, as you showed, the consensus is around 50,000. That sounds about right to me. There are a lot of cross currents here, but I think that's kind of where it's going to land. 50K would be consistent with the growth in the labor force, more or less. So, just about enough jobs to make sure that unemployment remains stable. 4.3% is where we are. That's probably where it stays. But, at 50K, it's pretty close to zero, and, pretty uncomfortable place to be, particularly given that the effects of artificial intelligence are now just starting to have to come on in terms of productivity growth. So, I'll take 50K is okay, but it's not that great, and certainly not a place you want to stay for very long.
Yeah, well, it's interesting how you phrase that. I mean, it's pretty much zero, and it feels like we've been living in this low hire, low fire labor market for a while now, kind of at a standstill here, not getting that much worse, but not getting that much better, Mark. I mean, how do you see this sort of developing as we head into the year ahead, and what sort of breaks us out of that standstill to either direction?
Yeah, well, the most likely scenario is that, we're going to get a little juice here from fiscal policy, deficit finance, the tax cuts and some spending increases. And that in combination with the juice from AI, the investment spending and the wealth effects from higher stock prices, if they stay in at high levels, that should power growth. And we should get a bit of a pickup in job growth here. Maybe if you told me the average monthly job growth this year is kind of closer to 75K, that sounds about right to me. Can't support much stronger job growth than that because of the highly restrictive immigration policy and the impact that's having on labor supply. So we can't get much more than that. But, Katie, I don't say any of that with any confidence. It feels very fragile, tenuous to me. Yeah. I mean, all this is happening without AI, and then you've got all these other uncertainties, and obviously the most pressing, most recently, is what's going on in the Middle East.
Well, with regards to AI, though, and the fragility there, Mark, I mean, there's been a lot of talk about exactly where the productivity improvements are, whether that comes at the expense of the labor market. A report earlier today by Bloomberg of Oracle actually planning to cut jobs primarily because of the added costs for that build out here. How much visibility do economists like you even have with regards to what that actual impact would be?
Yeah, not a lot. I mean, obviously, there's a boatload of uncertainty. One of the interesting things about all this is, economists are, when we do our forecasts and look to the future, we look at history in the past. If you look at the history of technology, and the technologies diffuse relatively slowly over time, they only really gain traction when new companies form and optimize around that new technology. So it takes time. So you see job loss as a result of technology, but you allow the rest of the economy to kind of create other jobs, and it all nets out and everything is okay. That's economists kind of want to go with AI, but that just doesn't feel quite right in the context of how all this is coming on so quickly. And then, of course, if you listen to the folks running these AI companies for just a little bit, just listen to a couple podcasts, go listen to the Bloomberg, podcast with some of these AI folks. Yeah. It makes you wonder whether history is going to be a good guide to the future here. And so we've got to be prepared for lots of different alternative scenarios. And thus my concern, I wouldn't be nearly as concerned if we were creating 100, 150, 200K jobs per month, which is what we were doing a couple of years ago. But we're not creating many jobs at all right now. And by the way, the jobs we are creating is in one sector.
Well, not even in the right sectors. I mean, even if you go back and you look at the internet boom, you look at the computer boom of the 70s, 80s, the internet boom of the 90s, there was tangible job growth that you can point to in the official government data that was a direct result of that. Now, this is not to say that won't happen with this, but we're certainly not seeing it yet, despite, the $650+ billion that these hyperscalers alone have committed to this build out.
Well, I guess you see it a little bit. I mean, I don't want to press that too far. I mean, you get a little bit on construction, right? I mean, all the data center construction is showing. So we are getting some construction jobs. But you're broadly right. It's hard to see any job creation, at least so far. And you just got to wonder, with these productivity gains coming in train, and it feels like they're coming. And there's a lot of anecdotes that kind of suggest that, the Block layoffs and the Morgan Stanley layoffs. You mentioned Amazon. That's the level of concern. So kind of the way I would frame it is the most likely scenario is a relatively sanguine one. We should be okay. You know, we should create 50, 75K jobs per month. But the distribution of possible outcomes here are is very flat. The tails are very fat, as the statisticians would say. So thus very hard to handicap what's going to play out here.
All right, Mark, got to leave it there. Mark Zandi, chief economist over at Moody's Analytics, with the focus today on tech and AI alongside geopolitics. And an announcement earlier today out of CVS Health, the build out of their AI capabilities. Tilak Mandadi is the chief experience and technology officer over there. A conversation with him when we come back after the break. This is Bloomberg.
Keeping an eye on shares of CVS Health, down with the rest of the market on news, not necessarily on the news, though, but the news came out this morning that the healthcare and retail pharmacy company is joining forces with Google Cloud through the launch of Health 100. Now, the platform will help consumers manage their healthcare needs regardless of which pharmacy and insurance provider they use. We got the chance to speak with Tilak Mandadi. He is Chief Experience and Technology Officer over at CVS Health about that partnership. Here's part of that conversation.
What we are creating, Katie, is a one-stop destination, kind of front door to healthcare for any consumer in America. If you think back to what frustrates the healthcare consumers in America today, number one, it's extremely complex to navigate all the stakeholders. There are pharmacies, there are pharmacy benefit managers, there are insurance companies, there are doctors. Navigating all of that is very complicated. So Health 100 engagement platform makes it very simple. It's very hard to figure out what costs what and what are the cost-efficient alternatives in healthcare. Health 100 makes it very simple for the consumer to get that type of clarity. It also makes it very easy to find care when you need it, whether that is digital async care or regular care. And it actually allows the consumer to take ownership of their own health and their health records, et cetera. So that's the idea behind Health 100.
And so what seems central to this platform is data, actually having data on it. And with that in mind, I mean, how many other health companies, when you think about insurance, when you think about doctors, for example, have actually signed up to offer data on the platform?
So the interoperability in healthcare, as you know, Katie, is a big problem. And we are absolutely committed with consumers' consent, getting all the data that is available for the consumer from all the stakeholders, whether that is through information exchanges, whether that is through EHR integration, or whether it is through direct connectivity. We are committed to creating that comprehensive health record for the consumer.
Let's talk a little bit about how AI factors in here, because I'm taking a look at your press release, for example, and this platform will use built-in agentic AI. And I want to talk about what that means in this context, the concept of agentic AI. How much autonomy will the AI actually have when it comes to, for example, ordering medical supplies or scheduling appointments on behalf of an actual human?
So that's a great question, Katie. Before I answer that, I want to be very clear. We are absolutely committed to responsible AI. We started out with a set of principles on what AI will do and what we will not let AI to do, and preserve that human touch that CVS is very known for. But having said that, the very unique part of the Health 100 platform is every consumer on Health 100 will have a personal AI agent working as a partner in their healthcare journey. So this AI agent with consumer consent knows all about the consumer based on the health profile, and is constantly thinking about what does the consumer need next? What does the patient need next? So this agent is a persistent AI agent with consumer consent, continuously focused on that particular consumer.
Well, I'm curious about additional costs. So I understand the upfront costs are already there, but of course, maintaining a system like this is going to require a tremendous amount of maintenance, of supervision, maybe even potentially additional compute power. Has that been factored into the forecast?
So the good thing about having done this across the CVS Health ecosystem is a lot of that infrastructure is already in place. And we know we have clear plans and clear thoughts on how to scale it as the business scales.
But Tilak, one thing though that seems different too when we talk about the build out of these technology tools, there's been a lot of talk about the pace of change now that we're seeing with regards to AI and the associated tools. That the idea that you can build an infrastructure today on a technology platform, and unlike maybe a few years ago where you would have a runway of years, maybe even decades before it needed to be replaced, AI is accelerating that to the point where, I don't know, we might have to have this conversation again in 2 years.
I think the way we have built this platform, Romain, is very consistent with the pace of AI. So the entire architecture is tied to with the understanding that we might use other models. We might change models. We might take advantage of a combination of cognitive AI and language models. All that was taken into consideration when we set this architecture to be completely flexible.
And our thanks again to Tilak Mandadi. He is Chief Experience and Technology Officer over at CVS Health. A really interesting conversation. Really speaks to, how companies across every industry are trying to harness and use AI. In this example, of course, healthcare, and a lot of questions there about data and, of course, how it's being used.
Yeah, way more complicated in healthcare because at the end of the day, you need my consent to use a lot of that data. I mean, Google and whatever, they can scrape whatever else I'm doing. But when it comes to my healthcare stats, that becomes a different animal. And that's the problem. It gets siloed off. And so how do you pan that out?
Yeah, absolutely. A delicate dance there. We'll continue to follow that story. But coming up, we're going to go from the healthcare space to the energy sector. Former U.S. Energy Secretary and founder of the EFI Foundation, Ernest Moniz, he joins us to give his outlook as the conflict in the Middle East continues. This is The Close on Bloomberg.
3:30 p.m. in a wet and soggy New York City. This is the countdown to The Close. I'm Romain Bostic.
And I'm Katie Greifeld, keeping a close eye on the equity market, but obviously a close eye on what's going on in the energy market as well. As we were mentioning a little bit earlier, WTI hitting $80 a barrel for the first time since January 2025, a little bit earlier today. And the direction of travel has just been higher.
Yeah, 81.01 was the official settlement there that we had just a little while ago. We're now in the new session. But I also want to point out, too, that surge that we saw during the session, which kind of came out of nowhere, because for a while it was kind of stable, then it bumped up. It was something like 9.5%. And that's the biggest one-day gain that I think we've had going back to 2020. Believe it or not. Yeah. So, and this is the sort of the yin yang right now, is that the market is really keeping an eye on what energy prices are doing, how that feeds into, of course, treasury rates, and then, of course, what the read-through is into equities.
Yeah. And of course, you take a look at the past 5 days or so, your top performing sector, it's no surprise, it's energy. But you think back to the conversation we were having with Venu Krishna half an hour ago, that maybe we're starting to see the light at the end of the tunnel when it comes to that outperformance when you take a look at some of these valuations. Absolutely.
We should also point out to our viewers, there was just a report on the Bloomberg terminal, an interview, a pen and paper with the Interior Secretary Doug Burgum, saying that the Trump administration is weighing options to address the spike in oil and gasoline prices. And I'll just quote it. Everything is being considered, and I think there are a series of ideas. Let's go to Ernest Moniz. He's a former U.S. Energy Secretary and now the founder and CEO of the EFI Foundation. Mr. Secretary, I do want to start off with the options on the table. I mean, when you were as Energy Secretary during the Obama administration or Undersecretary during the Clinton administration, you've dealt with energy price spikes. And I am curious as to what levers at all does the administration have to try to contain that, or contain the impact, I should say?
Well, of course, one of the options that's always available, although it's not always exercised wisely, I might say, is, of course, the release of oil from the Strategic Petroleum Reserve. We're down now, but we still have about 400 million barrels in there. But to be honest, if you look at the situation in the Mideast, in the Gulf. Clearly, the big issue we all know is whether the Strait of Hormuz is really operating. And right now, operationally, its traffic is, shall we say, very, very slow going through there, practically non-existent. So far, the price of oil, of course, has risen, the order of 10%. The price of the West Texas benchmark is, in fact, over $80. It hasn't been there in quite a while. And the fear is that if the strait remains closed for many, many weeks, that we will see a further run-up, possibly into the triple digits in terms of oil prices. But I also want to point out that there's a lot of focus on oil, but there's a huge impact on natural gas. Qatar exports a huge amount of the world's liquefied natural gas all through the strait. That's shut down. And we are seeing stable prices in the United States, but very volatile prices for natural gas in Asia and in Europe. Where, most of the gas from Qatar, in fact, goes to Asia, but a fair amount to Europe as well. So that's another big piece of volatility. And all of these may come back eventually to bite the American consumer in terms of rising energy prices.
Well, with regards to the options, I mean, obviously opening up the Strait of Hormuz, and I think based on Bloomberg data, I mean, we're showing that something like only maybe about 5% of the traffic is even managing to make its way through there as to what it would normally be. There's been talk about providing some sort of insurance, the idea that with the private insurers pulling back, that the U.S. would sort of go into the Development Finance Corporation and offer some degree of insurance to the government. Is that a viable option? And if so, how long does it take to get a program like that up and running?
Well, I think the president has addressed the right issue, which is reducing risk for ships, oil tankers, especially gas LNG tankers. But by the way, we should remember that I think the majority of the ships normally transiting the Strait of Hormuz are actually, commodity ships and cargo ships and the like. So the price impacts could be felt beyond oil and gas with a lot of inflationary pressure. But in terms of the options the president put forward, obviously military escorts being one. But as a reminder, we're talking about typically all forms of shipping, probably 80 tankers going through the strait per day on average. That's a lot of ships to be escorting, number one. Number two, what you mentioned explicitly is the United States government covering the risk premium on insurance. I think that's a nice idea in principle. However, I share the concern that you hinted at, namely, it may take an awfully long time, number one, to get this in place. On the scale of the hopefully relatively short shutdown of the Strait of Hormuz. But in addition, it's going to be difficult, I think, for the American political system to consider covering insurance by foreign insurers, insuring foreign ships, possibly carrying oil to China, let's say, and I have questions whether or not this is going to be implementable in any short time frame.
Right. You have to wonder, how the American voter is feeling about this entire situation right now. And we're going to find out, of course, soon enough as polling comes in, but also as we get closer to those midterms. But I do want to go back to, some of the different levers that the administration, that the government could pull when it comes to what's going on with oil prices right now, because Bloomberg News is reporting that, some in Washington have identified U.S. Treasury purchases of oil futures as a possibility here. Reuters reporting something similar, saying that Treasury could announce action on the oil futures market. I would love to get your view here, whether or not that would be something realistic, and if the Treasury did enter the oil futures market, whether or not it would make a meaningful difference here.
Well, it would take a very, very large purchase, and that's a major question. And of course, I think the president and many others have been very suspicious of all the resources being poured from the United States government into the private sector in various ways, including buying, for example, the Federal Reserve buying Treasury bonds. Now, clearly the point here would be to try to maintain a lid on short-term oil prices. That usually comes at the expense of having some longer-term increase in prices. So I think there's a lot of options here. Again, as I mentioned earlier, the most standard approach, I would say, has been to release oil. As you know, in 2022, for example, the Biden administration released a lot of oil from the reserve precisely to keep prices down after the Russian invasion of Ukraine. And that did provide some short-term relief. But as you know, there's a lot of discussion among economists in particular right now as to how that led to great inflationary pressures. So I think it's always a trade-off in some sense of the short term versus the long term. Yeah. And I'll be blunt, with midterm elections coming up, we may see a bit more short-term thinking.
All right, Mr. Secretary, I have to leave it there. Always appreciate you taking time for us. Ernest Moniz, former U.S. Energy Secretary, now the CEO and the founder over at the EFI Foundation. When we come back, we continue to assess the impact on stocks here in the U.S. And actually, one of the impacts is to the upside. Take a look at travel stocks. Booking Holdings, Expedia, having one of their best days going back for months. This unrelated to what's going on overseas, more related to OpenAI and, well, maybe a little bit of a back off. We'll explain when we come back after the break. This is Bloomberg. Shares of Booking Holdings up the most since April. This on the back of a report out of the folks over at Mizuho. The analysts actually saying that OpenAI actually scaling back some of those shopping plans for ChatGPT. That actually could mark the beginning of the end of major disruption fears for the e-commerce space, particularly with some of these online travel agencies. Norah Mulinda joins us right now, our Bloomberg TV markets correspondent. Wait, so OpenAI is backing off on this?
Yeah. Apparently so. So this is a report that we got out of the information, and they're essentially saying that they are actually pulling their plans. We do know that OpenAI had initially planned to embed a checkout inside of their ChatGPT bot, right, in the US. Now they're saying, no, we're not doing that. Apparently they were seeing that users weren't really, what I would imagine is trusting the idea of actually checking out within ChatGPT. Yeah. So now they're essentially making this pivot where they want to work with individual companies, whether it be Instacart, call it Expedia, one of these names, Booking, that's what we've been looking at today, and work with them so that actually you will talk through ChatGPT and it'll lead you to their applications, and that's where you'll make your purchases. Yeah. Of course, they'll still get a portion of the sales when we think about percentages, but
like a mob boss.
Right, if you will.
Yeah. It's really interesting. And I mean, just talk to us a little bit more about OpenAI's thinking here. You know, it feels like, of course, when it comes to AI, this is being built in real time, but still, why exactly the logic change?
Right, and as we're reading through the report, it's essentially unclear. But what we're still seeing from the data, and we're seeing the engagement from users, a lot of these users are also non-paying users. So you have to think about ways that you're still able to actually monetize that group of people that's not paying for premium ChatGPT. I don't know if you guys use ChatGPT and if you're actually paying for it, but many people are still just utilizing it, and they're utilizing it in a free fashion. So you're seeing them trying to really strategize how they can still make money off of this people group.
There's also the question, too, I mean, it's just about the cooperation, right? I mean, we don't know what really went on behind the scenes, but at some point, when you talk about sort of using what is effectively a proprietary platform in a Booking, an Expedia, whatever, if you're sort of integrating that into ChatGPT or whatever without their permission or their explicit permission, I would assume that would have had to been an issue as well. Do you think we're going to maybe see some of these companies actually just strike deals? I mean, assuming that, I think we all agree this is probably the future one way or the other. It's just a matter of when we actually get there.
So we know Etsy, Shopify rather, Stripe. These are all companies that we know have in the past teamed up with OpenAI, and they seem to be wanting to move forward with those efforts. But we did hear from the likes of Amazon, just last year they were saying that they were a bit apprehensive of working with AI-related apps like ChatGPT. They actually blocked them. This was Amazon, and they blocked them from showing their products in chat responses. And so now they're saying that they may be rethinking that decision. But you are still seeing companies that are wary, despite the fact that we do see this to be the trend. I've never done that, and I don't know that I'd love the idea.
No. Okay.
personally.
Yeah,
but
maybe I'd buy a sandwich or something just to test it out.
Maybe like a nice
You would trust the food?
Yeah, like a little burger.
Maybe a hamburger, no cheese though.
No cheese.
Melinda, it's great to see you. That is our Bloomberg Markets correspondent,
What
Norah.
is Gruyere,
Melinda.
by the way? Do you know?
Gruyere?
Gruyere, that's cheese?
Yeah, that's a cheese.
Oh,
I think it's
okay.
one of those maybe softer cheeses that you wouldn't like.
That's French, right?
Yeah,
Okay.
probably. Anyway, the closing bell is up next. We're going to take you there with Jaime Magyera. She joins us next. This is The Close on Bloomberg.
I think the risk that it spreads more affects the oil markets, affects the whole of Middle East in terms of what's going on, does create this risk, which, by the way, is not being priced with the markets. The market is behaving as if this is going to be contained and we very quickly normalize.
Venu Krishna over at Barclays kicking us off to the close just about 50 minutes ago. The good news, Katie Greifeld, is we are off the lows of the day, but still holding on to a good chunk of the losses.
Yeah, absolutely. Not seeing the dip buyers really out in force. We have 10 minutes, though. Something crazy might happen, but the S&P 500 down about 0.7%. I don't have oil on this board, and I should have, because we know that the Trump administration is watching the price of oil. You think about this report we got in the last couple of minutes or so, that the Trump administration eyeing all options to cut oil prices amid the war with Iran. Certainly top of mind.
Yeah, we had settlement earlier today at 81.01 on WTI crude. The news session slightly below that now at 79 and change. Now, as we count you down to the closing bells here, we're going to do something a little bit different today and take a much more of a longer term and structural look at what's going on in the markets. Jaime Magyera is joining us right now, head of U.S. Wealth Advisory and head of retirement over at BlackRock, who's been thinking a lot about some of these long-term shifts in the market, long-term shifts in where money is going, where money needs to be managed. And you see a big opportunity up ahead with regards to the number of women who are going to be looking for, I guess, maybe more creative ways to manage their money.
Yeah, and I'm glad. First of all, great to be here. Great to see both of you. I'm so glad you said that it's a structural shift. I mean, so often we talk about the markets and where money is flowing from an asset class perspective or a sector perspective. But when you start to think about where is money going from a human being perspective, it is going towards women. McKinsey projects that by the year 2030, 50% of global wealth will be in the hands of women. And it's not just the proportion, it's actually the rate that it's growing. Right? So if you go back just to 2018, it was 10 trillion sitting with women. By 2030, it will be 34 trillion. So the pace of growth is incredible. And there's lots of reasons, right? We talked about it. It's cultural, it's behavioral, it's longevity and demographics. But the bottom line is women are earning more and faster, and they're inheriting more and faster.
Dumb question, though. What do you have to do, or at least your team have to do, to, I guess, meet those people where they are? Does that mean different types of advisors, different types of investment products? What?
Yeah, so first of all, I'd say, at BlackRock, we have two goals. First is to give people the access to the full capital markets, and that's evolving, right? And we're modernizing how we do that, and we're giving people access to public and private and index and active. So that's our first order, is to help people live better and invest better. The second order is we don't have financial advisors. We help financial advisors. So all over the industry, financial advisors are serving clients, and they're trying to help their clients build portfolios. They're trying to help their clients achieve their goals. And so our job is to help those advisors. And so just today, as an example, we were out with some fantastic advisors this morning, and we were talking about how can they grow their business, how can they scale their business, and especially as you think about high net worth needs, as you think about women and men, the need for after-tax management, the need for customization, the need for estate planning, and everything else that comes along with it. It's getting a bit more complicated, and we're trying to help make it easy.
Yeah, that after-tax piece, it's so interesting to see the focus there, especially when it comes to some of the products that are being launched. But I want to talk a little bit more about financial advisors because, again, BlackRock doesn't have financial advisors, but you work very closely with them. Do you think that, when you take a look over the next decade and the years to come, that they will continue to be relevant? Because you think about, the generations coming up, they're growing up in this AI native environment. The muscle memory is to go ask an LLM, what should I do? Yeah. And, I wonder how financial advisors sort of fit into that future.
Yeah, so it was a topic of discussion this morning. with these financial advisors. So I'm going to use my own experience. And I recognize that I'm not growing up in a LLM universe, but I use my LLM all the time. And what I use it for is to get smarter, right? So I get information easier. I get access to things. It gives me confidence, it gives me context, and it gives me great questions to ask. And so, for example, when I go to the doctor, what do? I take my blood work, I put it into the LLM, and it gives me some questions to ask my doctor. Mm-hmm. And then I go see my doctor. I'm never not going to go see my doctor. I think the same is with financial advisors. There's always that last second of trust that you want from a human. And I think it's less about advisors being replaced. I think it's more about the best advisors are going to know how to use AI to make them more productive, to make them better with their clients, to personalize what they're doing with their clients. So they have to use it to be better.
Yeah, it's so interesting. It feels like, in so many different scenarios, still you want a human to have the last look or the last word, whatever it may be. But I do want to talk a little bit about retirement, which fits into the conversation on the wealth transfer, but specifically what we're seeing unfold in the private marketplace right now. A lot of scary headlines when it comes to what's going on with private credit and private assets in general. Have you seen that impact the conversation that you're having with some of your investors as to whether there is demand to put private assets into 401ks, for example? Yeah, so it is. Look, there's so many headlines out there. And think about the participants everywhere who are trying to make sense of this, the everyday people who are trying to understand. When we talk to plan sponsors, when we talk to financials, when we talk to institutions, really what the question becomes is, what am I solving for? And if you think about your employees are living longer than ever before, and the responsibility of savings is now more on the employee, right? Pension plans are not growing, they're shrinking. And so it really is the defined contribution plan as well as personal savings. So that's point number one. Point number two is that the capital markets themselves have just modernized. There's more access to more things. And if you're not thinking about the full platform of what you could offer your employees, then you are actually in ways doing a disservice by not looking at the whole power of the capital markets across public and private. Third, though, is it has to be done in the right way. It has to be done with the right managers, and it has to be done in a portfolio that's integrated and diversified across public and across private. And so that's the conversation we're having. There is a lot of interest, but this moves slowly. Right, and so it's not going to suddenly be an overnight thing, but I do realize, and I see it with our clients, is they do understand the world is changing, modernized, or the markets are modernized, and DC plans have to follow. All right, Jaime, you have to leave it there. Great conversation, and hope to have it again in a much longer format. Jaime Magyera there is head of U.S. Wealth Advisory and head of retirement over at BlackRock. We count you down to the closing bells with just about 2.5 minutes to go, Katie. We continue to see the dip buyers come back in and try to rescue this market, but it looks like, barring a huge turnaround, we're still going to finish in the red. Yeah, absolutely. I mean, the session lows was 1.4% lower on the S&P 500. So as you mentioned, well off those levels. But you take a look at the breakdown of this market, and certainly at the individual stock level, more losers than gainers at this moment as we are minutes away from those bells. Yield still elevated. So too is the VIX, the dollar back on the upside. A full breakdown of all of today's market action and a push ahead to some key earnings coming after the bell. That conversation starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube to parse the most crucial moments of the day. And another wild day it was, Carol Massar.
Man, it was wild, right? And we're looking at a market trade that, we're still down across the board, but we're seeing some buying here into the close. So definitely off some of our worst levels of the trade here. In the S&P 500 today, the worst level was 1.44%. Now we're down to only about 0.6%. So kind of a similar story that we saw a couple days ago, where the lows happened earlier in the session, and then we recovered from those lows. The question is, what shifted for investors? What are they looking at differently? Yeah, not clear what is driving the bounce back, other than maybe the fact we're just getting closer to the close. But it was interesting to see that big drawdown earlier in the day on this Bloomberg News headline that the U.S. is considering requiring permits for global AI chip sales here. Basically, the U.S. would then be the
gatekeeper, and that certainly took a chunk out of the likes of NVIDIA, out of the likes of AMD, and you're seeing that still when it comes to the stocks.
And now NVIDIA's higher, though.
Now, one thing that was interesting, too, when we look at the index level, too, that's different. You know, it was, and Dan Curtis pointed this out, the idea that the last few days, we still, wherever we open, we still manage to close above that, even if the day was down. Today, it looks like it's going to be different, where we are actually going to close below where we opened here. So it gives you some idea here as to the idea of momentum and whether that momentum is still, despite the dip buying that we saw here into the closing bell, still potentially to the downside. Let's walk you through the numbers here on this Thursday afternoon. The S&P 500 down roughly about 39 to 40 points. It takes a while for these numbers to settle, but it's still going to be a drop of about 0.6%. The Dow losing almost 800 points, or about 1.6%. The NASDAQ composite down about 60 points, or 0.25%. And the Russell 2000, that's one of your biggest laggards here on the day, losing about 50 points, or 1.9%.
All right, just digging inside the S&P 500. Even so, we are no surprise to see most names, Katie, in the S&P 500 lower for the Thursday trade. 365 names to the downside, 137 gaining ground today, and you've got one unchanged.
Similar breakdown when you take a look at the sector level. 3 sectors finishing in the green, 8 in the red. In terms of what did well today, you can see tech up there performing higher by about 0.4%. Energy was your winner on the day, higher by about 0.6%, even with this Bloomberg News article that the administration is basically eyeing all options to cut oil prices. Meanwhile, all options, okay, including maybe action when it comes to oil futures. No, all of them. Okay. They're all on the table. All right. Consumer staples down about 2.4%, Carol.
All options? You mean maybe they'll pay when I fill up at the top?
It's theoretically on the table.
That would be inflationary, I feel like.
Would it be inflationary?
Yeah, if they paid for your gas. Absolutely.
Maybe we'll find out.
Let's get to some of the individual gainers.
Doesn't drive, does he?
I love to drive. Who doesn't love to drive?
The open
safely?
road.
Yes, safely. Okay. Oh, my goodness. All right, let's get to some of the individual gainers. This was the number 1 gainer in the NASDAQ 100, number 3 gainer in the S&P 500. I'm ignoring you. Booking Holdings, a gain of about 8.5%. Mizuho. I know, I always... Oof. All right.
Ignore him.
Jeez, you're killing me. Mizuho. Moving the firm's top pick in internet to Booking Holdings away from Airbnb on the expectation of a major relief rally, and this coming after the information reported that OpenAI is pulling back from native ChatGPT checkout, pivoting instead to app-based purchases. So the firm believes that ChatGPT's reported pivot away from on-platform shopping checkout, if true, could spell the beginning of the end of major disruption fears for internet marketplace businesses, including online travel agents and others. So they're liking this one in a big way. So investors moving into that. I think you saw investors move into Expedia as well. Let's go to Broadcom. It is top in the NASDAQ 100, up about 4.8%. We did see the stock bouncing around last night after it reported its latest quarterly update. It did settle in today higher after the company posted first quarter results that beat expectations on key metrics, gave a positive revenue outlook. The CEO, Hock Tan, saying the company expects its AI chip sales to top $100 billion next year, and that they've got the supply chain to do it. Super important, marking major inroads into territory dominated by NVIDIA. We know where they're trying to go after it. And then here's for something different. I'm hoping you're going to find this entertaining, Romain. We are seeing Sable Offshore.
Why would that be entertaining? I'm very familiar with this story. Let me see where you're going with this.
Oh, okay. Well, see, you know everything. The stock up about 37%. It's a $1.8 billion market cap oil and gas exploration company, jumping today, extending a recent rally to a 5th straight session that has pushed the stock up about 60% in the past 5 days. This amid news earlier this week that the Trump administration will seek to invoke an act to allow the company's Santa Ynez pipeline unit to restart energy production. Keep in mind, 27% of the float is short. Yeah. So tell me more. Is there more that you want to add to it?
No, I thought you were going to say something funny or interesting.
Yeah, that never happens. You know, that's what my brothers always say. They're a tough crowd, too.
All right,
Jim,
let's
take it
go to
away.
some of the decliners on the
I have
day
to meet
today.
these brothers. They sound cool.
They are a lot of fun.
I'm looking at what happened to ADRs of Roche today, down 6.3%. Midday, we saw shares take a dive. This after we got results of Roche Holding and Zealand Pharma's experimental obesity shot. It helped patients lose as much as 10.7% in a study with side effects comparable to that of a placebo. The reason why shares fell is because investors compared that to a similar drug from Eli Lilly that delivered as much as 20% weight loss. So that result underwhelming to investors. StubHub Holdings not having a very good day. The ticket reseller shares fell by 12.4% today. This after the company's 2026 forecast and fourth quarter results came in below Wall Street estimates. Analysts pointed to challenges for comps because there's not a Taylor Swift tour to boost sales. That is the power.
She has to take a break
That's
every
the power
once in a
of
while.
Taylor Swift, I guess.
She's got to get married, maybe start a family.
A couple firms also downgraded the stock. Shares fell 12.4%.
Were there no other tours?
I mean, it's Taylor, you know.
Oh,
she drives
busy.
it around the world.
Yeah. Do a loop.
Bad Bunny.
He's
That's
the
a big one.
Yeah.
That's a big one.
Yeah.
I'm also watching shares of UPS, United Parcel Service. They were on
this is
track.
interesting, yeah.
Did you see this? They were on track to actually close at a market value that would fall below FedEx for the first time ever, reflecting investors' lingering anxiety around UPS's long-term growth trajectory. There was a little uptick at the end of the day. FedEx is at $87 billion in market cap. UPS still above it at $88.35 billion. So that day, Romaine, will have to wait.
All right, let's get to some earnings. Marvell Technology, the semiconductor maker, out with its results here, 80 cents a share. That is the bottom line number, a beat of about a penny. Revenue in the most recent quarter, $2.22 billion, basically on the nose of what the street was looking for. Not seeing a revenue forecast jump out at me, but adjusted gross margins also coming in line with estimates at about 59%. But you see the knee-jerk reaction there of up about 6%. We'll try to dive a little bit deeper to find out exactly why. And let's take a quick check of yields as well. We're actually up for a fourth straight day on benchmark 10-year yields. It's something that, of course, hasn't actually happened since early December of last year. A repricing out here of Fed expectations. You see that also reflected in your 2-year yield higher by about 3 basis points.
Hey, quick commentary on Marvell in the press release. Company's chairman and CEO, Matt Murphy, he says, we expect year-over-year revenue growth to accelerate each quarter in fiscal 2027, driven by continued strength in our data center business, with bookings continuing to grow at a record pace. So maybe investors certainly excited about that. Hey, what I'm excited about is that thank you, United. So they basically have updated their policy. Just listen. Okay. This is the whole point. Listen. They're going to require passengers to use headphones for audio or video. I don't even know why we have to tell people
I know why
to do this.
I know
Have you been on a plane lately?
If you don't do it, they can remove you from the flight and possibly do a permanent ban. Read the fine print, folks. And if we could just do that on subways here in New York City, please.
Carol's fired up here.
Because
who hurt you, Carol?
No, it's like, be considerate.
Yeah.
Huh.
I do want to know, I mean, how many repeat offenses do you have to be permanently banned from the airline? That is my big question reading this story
Who's
here.
going to remove them, though? Are we putting this on the flight attendants again? I'm starting to feel sorry for them. Yeah, they're already dealing with all kind of unruly stuff.
Yeah.
So, but Carol, you seem very...
I'm happy for you, Carol.
Listen, I love people. I love the sharing concept, but sometimes I don't really want it on my ride home.
I don't want to share audio.
I don't want to share audio either. Yeah. I don't want to hear what you're listening to. I know you think it's dope, but I don't. So.
I have no comment. All right, I'm wrapping because family just told me to wrap. All right, that's it. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing, of course, on The Close on TV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow. Please wear headphones.
And our coverage continues here on Bloomberg Television. We are awaiting results out of a key retailer, Gap. We'll break them down as soon as they hit the tape right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. We're now the 4 straight trading days since the war in Iran began. And every single day we've seen a similar pattern. Stocks under pressure, but dip buyers coming in. A couple of those days we actually did see the market actually push back into the green at the close. Today, not quite there, but well off the lows of the day, down more than 1.5% at one point there. We also saw a lot of pressure today in chip stocks here on the back of a new policy here that might actually restrict exports of chips. But keep an eye, of course, on what's been going on in the energy space, Katie, and in the yield space, because that's been a big driver of broader markets.
Absolutely. I want to go back to what Romaine was saying about chip stocks, though, because NVIDIA initially led the drop down, and you can see they managed to finish in the green despite the report that we saw earlier. NVIDIA shares finishing about 0.2% higher. And then you take a look at Broadcom. Of course, they reported earnings about 24 hours ago, delivering a pretty upbeat forecast. You can see shares rising about 4.8%. And then this is a really interesting story. Berkshire Hathaway CEO Greg Abel coming out and saying he's going to use all of his take-home pay to buy Berkshire stock, and take a look at what it's doing, higher by about 2.7%. Let's get to our top story this hour, wrapping up a week of retail reports. Target, On, Abercrombie, Victoria's Secret, all in the books, with these consumer-facing companies already issuing warnings due to the conflict in the Middle East. Abercrombie's CFO anticipating, quote, a slight sales headwind, while Victoria's Secret saying that it's experiencing some shipment delays. Now this, as we get set for results out of Gap and Costco, those are due to drop any minute. So let's get now to Wendy Liebmann. She is CEO and Chief Shopper over at WSL Strategic Retail. And Wendy, as we await for those Gap and Costco results, let's talk a little bit about what some of these companies are dealing with. We already had the tariff situation here that they had to digest. Now you think about what's happening in the Middle East. What does this potentially mean for supply chains, which have already been stressed?
Yeah. Hello, Katie. You know, I think part of this is, will the stock be on the shelf? Will it be on the shelf when shoppers want it? Because they're already feeling nervous from the end of last year, beginning of this year. And for them, really, more than anything, it's the impact of gas prices, because that hits their pocketbooks really fast. And if that takes money out of their wallets, then that more than anything else will impact how they're spending for anything.
I am curious, Wendy, though, about this idea of attracting shoppers. Well, let's first start off with just retaining the folks that you have, but also the idea of bringing new people into the fold. Probably a little bit less of an issue for Costco, certainly an issue for Gap.
Yeah, I mean, part of this is now there are so many options for lower prices if you want them, including using AI to do it. There are so many options for other places to shop, which people do already. So the challenge is balancing innovation and getting people tempted with, is it worth the price? And that's some of what that tension that we're seeing now. And from Gap, they've been doing a good job reinventing what the Gap brand, the individual Gap brand means. Yeah. And that's part of the conversation. I think we're all eager to see what the results look like.
Is it just about price, though? I mean, they also have to have the goods themselves, meaning the style and okay. Yeah.
Right. All right. That's what I mean by innovation.
Gotcha.
I mean, one of the things is I can buy denim anywhere at any price. I can buy T-shirts anywhere at any price, fill in the blanks, right? So with all of that, that's part of it. The lowest price, so what? I can get it if I need it for the kids, for myself, for the weekends. The difference really is there something even interesting for me to buy to get me off my couch and into the stores or online? So that's what we've been losing in many of the retailers who are more fashion oriented lately. They just haven't been really compelling. Gap's been doing a good job both in their styling, but also with their marketing, which has brought their, different consumers, new computers, see where I am, back into the stores.
Yeah.
Well, right on time. We do have these results out from Gap, so let's walk through some of the headlines right now. When it comes to fourth quarter net sales, coming in at $4.24 billion, right on the screws in terms of the estimate there. When you take a look at where they see first quarter net sales, expecting 1 to 2% 8% growth here. Also getting fourth quarter EPS for Gap coming in at 45 cents. The estimate had been for 46 cents. And just to get into one of their brands, Old Navy, which has arguably been sort of the bright spot of the Gap portfolio. Those comp sales coming in at 3% growth in the fourth quarter. The estimate had been for 4.35% romaine.
I wonder if that's kind of weighing on the shares, because I'm looking at the full year forecast for Gap overall, 2 to 3% on a net sales basis, which would actually be slightly above what the street was looking for. But they're still talking about a margin impact, 150 to 200 basis points. And Wendy, I am curious about this idea, too, of kind of managing through turbulent times. Obviously, we're talking, when we talk about apparel makers, retailers, a lot of them heavily dependent on the import market, not to mention just other factors that are going on that could disrupt the supply chain.
Yeah, I mean, I think it's all of that. I mean, we had the tariff conversation, the supply chain issues that we're starting to see now, or more anticipation of those that will happen. You know, just the cost of gas to ship things, all of those things have an impact. So managing in crisis, both for the average American household as well as the average American retailer, is really a challenge every day, day by day. And that's what I think we're seeing in this caution, whether it's from the Gap or any of the other retailers, even if they had really good results so far this year.
And just to dig into those Gap results a little bit more, I mentioned Old Navy. You saw comp sales miss estimates there. You also saw a similar result when it comes to Athleta missing comp sales expectations. Gap, though, of course, namesake brand there, and Banana Republic beat. And I'm curious, Wendy, when you take a look at the Gap portfolio right now, what you make of it. We know that Athleta has been a little bit of a problem, and trying to bring that back that momentum has been certainly a struggle.
Yeah, and I think, again, lots of competition in that space, whether it's more the high end of, the Lululemons of the world or Aloes. You see a lot going on in that space. So they had been quite slow to respond to the way consumers, shoppers were thinking about athleisure, whether it's for real fitness or whether it's just for everyday look. So I think there's a lot of catch up still for them to do there. But you can see the success in general of Gap, the Gap brand, where they've really put the effort into design and new marketing voices to make it more contemporary. So I think that's the other piece that we're seeing in that sort of vision, I guess.
Well, we only have about 60 seconds, Wendy, but I'm curious as to when you look across the landscape, I'm not just talking about Gap, and you look at some of those companies, those legacy retailers and apparel makers that have found new footing, who stands out the most?
As I say, I do think Gap Inc., Gap the brand, has really done that. I think other than that, as you look at some of the retailers, some of them are doing a better job with their own private brand, which has made this much more competitive as well in this space. And we see brands like Lulu doing better selectively. Yeah. So I think, we're seeing that little bit of effort, but it's got to be about innovation and it's got to be about value.
All right, Wendy, always a pleasure. And I got to step my flower game up. Wendy Liebmann, CEO and Chief Shopper over at WSL Strategic Retail. We're also getting some earnings, Katie, out of Costco. The company saying that for its fiscal second quarter, comp sales up 7.4%. That's above what the street was looking for. U.S. comp sales also coming in above what the street was looking for. The company saying EPS, the bottom line number, $4.58. The street was looking for $4.55.
Yeah, you can see traders kind of deciding what to do with the shares after hours, higher by a fraction here. I do want to point out that Costco, through today's close, higher by 14% on a total return basis year to date, so quite a strong start.
All right, a deeper dive into what's going on in the retail sector with the retail legend, Mickey Drexler, coming by the program in just a bit. Stick with us. This is The Close. Welcome back to The Close, continuing our focus on the retail sector. We had a chance to actually catch up with the founder of the Ugg brand. I had a chance to ask him about longevity of the brand and what kind of advice he gives future brand ambassadors as they come up through the pipeline. Take a listen.
The principles of marketing and building a brand have not changed. And I wrote a book called The Birth of a Brand, and the theme of it is you can't give birth to adults. Every business starts with conception and then the first action. So me buying samples from Australia was the birth of Ugg, but then every business goes into this infancy. This infancy where, it looks like it's failing because it doesn't do anything. But if you can keep, working at it and you believe in it enough, it'll start the toddling stage, which is where people start to get interested in your product. And then you'll hit the youth best phase of all. And if it's a great product or service, you'll go into the teenage years. And that's, when you really start to come up with all the big business problems, and it'll eventually mature just like Ugg did. So if you're a new person starting out, that first aha you have where you're going to be an instant millionaire, stick with it, but know that you're going to go through these phases.
Well, Brian, I want to ask you a question about what the difference is between a product and a brand. And why that distinction matters.
Great question. Yeah. Great question. A brand is not your trademark registration. A brand is not your logo. A brand is what consumers think about you. It took 4 years before I understood advertising and marketing. And the theme is you never sell your product. You sell the feeling, the emotional tie that you want people to have with your product. And so if you're a new person starting out with a new footwear brand, that's what you have to conquer, is how do you get your audience to absolutely be in the photograph or the video or whatever it is. That's the trick.
And how do you sort of maintain, though, that brand authenticity once you start growing and scaling up? I mean, I feel like it's probably easier to do that when you are small and can take bigger risk. But once you become bigger, of course, taking bigger risk also means the potential for bigger failure.
Yeah. Well, the evolution for me was I started with those youth surfers, and that was highly successful. So I thought, oh my God, snowboarding is just beginning. So I went into all the snowboard magazines, and that was a huge success as well, advertising to the youth. And I was stuck in the Midwest and the back East because I didn't know what the kids did in the wintertime, and eventually some sporting goods retailer told me, oh my God, Brian, they play hockey. And being Australian, it was an alien sport to me. But I advertised to the youth hockey, and that took the brand, nationwide. But there was something missing. There was I was all these fragmented images, which was not good for the brand. So I came up with this theme, casual comfort, and I started to advertise that. And I had a really successful campaign in USA Today. And that sort of took it into the Hollywood area and the celebrities area. And that's when the traction for the brand, even though we were doing 5-6 million at the time in sales, that's when the traction started to go in, and that drove it up to the 10 to the 15 million stage. Are
you surprised at the longevity of the brand, that it not only still continues, but is still thriving? I knew it would be a phenomenon once it took off. I thought it would be a year or two and I'd be an instant millionaire. But it took nearly 20 years before I got to the stage where I had to sell it. It just got too big. And I predicted back then it would be a $200-300 million company. So the answer is no. I never saw it being $2 billion a year at the time. If there is sort of a young Brian Smith out there today who's tinkering around with an idea in his or her head, what's the one piece of advice that you would want to leave with them?
If you believe in your product, just don't give up. There's a great saying that once you start out on a path, the universe will conspire to work with you. That is so true. And as long as you keep forward momentum, things will keep dropping into your awareness about, oh my God, I could use that channel. Oh, that person there could help me. As long as you stay in momentum, things will just fall in place eventually. It seems like it's agonizingly slow. But again, the theme of any business, you can't give birth to adults. If you hang in there, eventually it's going to rise to the top.
Part of our conversation with Brian Smith, the founder of the Ugg brand. Of course, he sold it to Deckers quite a few years ago. You must be a fan of Ugg, 'cause I know you have other Deckers shoes like Hoka's in your closet, right?
Yeah, no, not an Ugg fan.
No?
No.
They're so warm.
They really came of age or in popularity when I was in middle school. All the cool girls had them. I was not part of that clique, but great question.
But you're cool now.
Yeah, I got the last laugh. This is Bloomberg. Well, Well, we're taking another check on retailers Gap and Costco following results. You can see both names down here. Gap much more so, down about 8.3%. So let's get a little bit more insight when it comes to the state of the retail industry at large and also the consumer. And we go to a legend for that. His name is Mickey Drexler. He is the chairman of Alex Mill and former CEO and chairman of J. Crew Group. Of course, also spending many years at Gap as well. Mickey, it's great to see you.
You too. Thanks.
So it's interesting. I mean, you take a look at just this week when it comes to what we've seen from Abercrombie, American Eagle, now Gap falling in the after hours. It seems like a really tough reception, at least in the stock market, for some of these apparel makers. I wonder, when you take a look at the lay of the land, what you're seeing.
Well, what I'm seeing, and I do my surveys when you all invite me on, I think what I hear, business is pretty good around, whatever that means. But I think, look, for me, it's never been about estimated earnings, even though I was forced to do that. And a lot of things are judged against estimates. And the real deal is judged against LY and the longer term growth. I think it's about the merchandise always, and I'm less impressed with the merchandise I see around now. I think it's about longer term viewing. And at the end of the day, it's about merchants running merchandising companies. Mm-hmm. So what I see...
Sorry, when you say you're less impressed by the merchandise around, is that because the quality or the style? What's not impressive?
Multiple choice. And it depends on the company. Yeah. There are some companies that just stay on the program, they do what they do, and others are short term. Look, I lived with the stock market for 30 years, but it is what it is. Mm-hmm. But...
I do want to talk a little bit about what we're seeing at the tariff front, because there has been a lot of back and forth there. Of course, the Supreme Court overturning those IEEPA tariffs, President Trump saying that he's going to, implement 15% levies across the board. It's very fluid, to put it mildly. I mean, merchandising aside, how do you think that is impacting some of the C-suites who are having to make decisions about, what they're able to get on the shelves, what their supply chains look like?
Well, the last time I was here, we were all flying blind. The Supreme Court decision was a bit of a celebration for a lot of us. Even with the extra, I don't know if it's 10 or 15%, we are still ahead, for example, in India and China, than where we were with the original tariffs. So I'm resting, and we're resting a bit easier, but you never know in this environment what can happen. But we're feeling good about, our business, I'm feeling very good about it. About time I felt good about it. But I think, the industry is not filled with product merchant people, enough of them. And I think that, AI, it'll be helpful in some areas and it'll cost a lot of jobs. But it's not going to pick colors. It's not going to design clothes, although I've had that debate. It can design, and it doesn't have emotion.
Yeah.
And in our business, emotion and connecting to merchandise and marketing is what drives the business.
But you've seen a lot of retailers gravitate to AI and some of these technological tools to try to reach their consumer now. And there's been a big debate as to how you keep that human touch, but at the same time, sort of incorporating that technology. The fact is, shoppers are using it. So, what's your approach at all at Alex Mill, if you have one?
I plead not knowing much about it.
Okay, fair enough.
And I also have some team members who know how to use it. Mm-hmm. But I think great merchandise and product will not be impacted by AI, in my own opinion. Technology, for sure, Chat GPT and all that. But it's about, if you like the jacket, you like the jacket.
Right.
And I don't think AI is going to tell you, buy more of that jacket. Mm-hmm. And I think, and I was speaking to someone today who I chatted with, and they're talking about having demand analysis. Mm-hmm. So I said, I don't know what that is. If you buy 100 and you forecast it out, maybe you should have bought 1,000 and then you forecast out. Mm-hmm. That's a merchant's role. Mm-hmm. And it's in any industry.
Yeah.
You got to look at the assortments.
But you've seen the technology change over time. Even when you were running a J. Crew and Gap back in the days, there were change. I mean, you saw the change. Obviously, there was a certain period where you had to go into a store. Then we had e-commerce.
Of course.
I mean, you had catalogs, but then the e-commerce and all that. And now, I guess, at some point, AI. Who knows where that's taking us? But that'll probably evolve us into something else, right?
Yeah, I think there's going to be involvement. But technology, I think, has taken a bit of the creativity out of the life of products. Because at the end of the day, even the car companies, I don't know the difference between most cars anymore.
Yeah.
They all look like they're designed in the same design room, maybe by the same computer.
You feel the same way about clothing now? Overall?
Clothing?
Yeah.
Well, look, they talk about prep coming back. Now, prep is prep, and coming back, I think people are looking to label it, so they'll call it prep. But having grown up in a non-prep environment, school in the Bronx, prep was a look, a specific look. It wasn't just clothes being normal-ish. And I find that there are some retailers out there who are doing it really well, and you see it by their stock prices longer term. But I think it's all about the people and the leadership in every single environment. The fish stinks from the head down.
I can viscerally picture what you're saying there when you talk about fish. But let's talk a little bit about athleisure.
I don't want to talk about fish too much, but I learned that from a hotel manager.
From the head down.
Yeah.
I'm going to write that down. But I do want to talk about athleisure. I would love to get your thoughts on that category in general because, you think about Gap with Athleta. They've had their struggles there. Lululemon certainly as well, though there might be some more idiosyncratic issues when it comes to Lululemon. But overall, it feels like the category has sort of lost steam. There's a lot of competition as well. What do you make of what you're seeing there?
Well, again, I'm not an expert. I just observed the scene. I used to be affiliated, not a fun experience, with Outdoor Voices, which I thought had a good opportunity, but that's another story. I think it's boring-ish. You walk into a shop and everything's kind of muted colors. And we're looking at the spring collection yesterday, and you put the goods up on the wall, and I said, that sweater in 10 colors is boring. Now someone says, why do you think that? How do you explain that? And I say, tell me what you think of chopped liver. Do you like it or not? It's very hard to be a merchant today and have a point of view and an eye. I think athleisure, I hate the name, by the way.
Yeah.
It covers so much ground. And Lululemon, they had a monopoly. And, when you have a monopoly and you have a lot of competitors out there, it just hurts. And it's about the vision of the management and the owners on where they take that.
Yeah.
And that's, in my own personal experience, that was always the solution. And if you didn't take it to where it should go, you got your butt kicked.
Yeah. I do want to ask you a little bit about pricing in this space. I mean, anecdotally, it does seem like a lot of retailers are holding the line a little bit more on pricing, not discounting as much as you saw a few years ago. I know Alex Mill has always been tried to sort of hold the line. And,
we hold the line.
Hold the line. But you're seeing a lot more folks do that. And I am wondering what gives them the power to do that? Because there are some folks who can do it. There are other places I just know, again, anecdotally, I'll go to, and if I don't see a discount, then I move on.
Well, I don't know how much power they have. I can name a number of examples. Because before I come on and schmooze, I go online and I look at the deals that companies have that are online deals, or the clubs you belong to deals, or in the red lines through the websites. So I think their whole, I don't know much about it.
Yeah.
But you can't compete with the real serious discounters. I spoke to a friend of mine who I worked with for years who runs one of the top 3, he's number 2, discounters. And, Walmart and Burlington, not Burlington Coat Factory, he's with Burlington.
Yeah.
And Ross stores, they're all formidable, and I think they're doing well. I think the earnings are good.
Burlington this morning.
And the lower income customer, what I'm told is they're seeing bigger tax refunds based on no tax on tips, child credits, et cetera.
Yeah. All right, Mickey, we do have to leave it there. We have some breaking news. Always a pleasure to catch up with you. Okay. Mickey Drexler, he's the chairman of Alex Mill and, of course, the former CEO and chairman of the J. Crew Group.
Meanwhile, let's dip into this event happening at the White House, listening into President Trump.
Their arms, they're only going to be killed. And now is the time to stand up for the Iranian people and help take back your country. You're going to have a chance after all these years to take back your country. Accept immunity. We'll give you immunity. And we'll be giving you really the right side of history, because that's what it is. So you'll be perfectly safe with total immunity, or you'll face absolutely guaranteed death. And I don't want to see that. They don't want to see it either. We also urge Iranian diplomats around the world to request asylum and to help us shape a new and better Iran with great potential. It's a country with great potential, as much better future for Iran. It's now beginning. It's going to be, I think, a great future. And the United States will ensure that whoever leads the country next, Iran will not threaten America or its neighbors, Israel, anybody. If you look at what happened, they had missiles aimed at all of these other countries, Qatar, Saudi Arabia, UAE, many others, that weren't really involved very much, and they had missiles aimed. Well, they were aimed there long before this ever started. They were going after the entire Middle East. And then we came along. We blew up their party. So we have phenomenal people. I want to thank all of the people that have been involved. Marco, you've been doing a fantastic job. And you've been doing a fantastic job on a place called Cuba. And A-Rod came in before. I said, hey, do you want to come up to a little award? He's gone to plenty of award ceremonies. Thank you, A-Rod. Big fan. But what's happening with Cuba is amazing. And we think that we want to finish this one first. But that will be just a question of time before you and a lot of unbelievable people are going to be going back to Cuba. Hopefully not to stay. We want you back, and we don't want to lose you. We don't want to make it so nice that they stay, but some people probably do want to stay. They love Cuba so much. I hear it all the time. That was another one that wasn't supposed to happen. Venezuela is going great. It's been stabilized. We have a wonderful person as your president-elect, Delcy Rodriguez, and she and her staff have been doing a fantastic job working with us. We're taking out hundreds of millions of barrels of oil, and it's going to Houston and various other places where it's being refined, and we're sending them back far more money than they've made in many years, and actually very shortly it'll be more money than they've ever made. And Venezuela is working. So we've had a lot of countries in places that truly love, you would say football, I would say soccer, but these are all countries that love football/soccer. And so I think the group likes it. And if you'd like, you could sit. I know I'm a very exciting speaker, but you can sit down if you'd like, okay? I'm looking at everybody standing. I'm saying, let's sit down.
The President of the United States speaking at the White House right now. You see behind him, of course, the MLS championship. He did mention, of course, the situation going on in Iran, issues in Cuba, as well as in Venezuela. You can continue to listen to his full remarks by typing Live Go on the Bloomberg terminal. And Katie, there's obviously a lot going on still with regards to the situation in Iran. We are awaiting a press conference from the Defense Secretary Pete Hegseth at some point this afternoon to update us on the situation. A lot of headlines about what's going on over there. Still a fluid situation, but what we do know, based on Bloomberg reporting, the Strait of Hormuz still effectively blocked off right now. And a lot of folks, a lot of people who have been trying to get out of the Middle East to get back to their respective home countries still having trouble getting out. Let's go to Nick Wadhams right now, our man down in Washington, to talk a little bit more about the situation as we know it. And Nick, in terms of the policy and in terms of the next steps, what do we know about what the administration has in store?
It's a great question. I mean, in terms of the military campaign, the administration has been signaling over the last 24 hours that they are only going to step it up. So they essentially decimated Iran's coastal defenses, those air defense systems, and then a lot of the ballistic missiles along the coast that pose the greatest threat. Now they want to move inland and do more precision strikes with aircraft, so the kind of aircraft that would have risked being shot down if those air defenses had been in place, to really degrade several things. So we believe the nuclear program, the ballistic missile program, and Iran's ability to make drones and launch drones. So the signals we're getting here are really that they are stepping this up and that there is absolutely no end in sight when it comes to this campaign.
And in addition to Iran, we also heard a bit about Cuba. We also heard a bit about oil, Nick. The president saying that oil seems to have pretty much stabilized, but also saying that further action to reduce pressure on oil is coming. This matches Bloomberg News reporting from earlier in the day. Do we have any sort of timeline on when that might come and what exactly we're talking about when it comes to action?
The president has not disclosed that. I mean, but this is a big issue for him because he's made low gas prices such a priority for his administration. I mean, he even talked about it at great length in the State of the Union speech. So if you really start to see oil prices spike and the tension around disruption at the Strait of Hormuz affect prices back home, I mean, then that's going to be a serious political problem for him.
All right, Nick Wadhams down there in Washington. And a reminder here, you can continue listening to the president's comments by typing live go on your Bloomberg terminal. We'll be back in a moment. Sports memorabilia, it's big, and it's making its way into the world's biggest auction houses. With NBA legend Scottie Pippen, a collection from his on display right now this week at Sotheby's. We had a chance to catch up with Pippen earlier today to talk about what he's got in store. Take a listen.
Once I started to look back at it and go back through it and see it all laid out, it was kind of tough for me about the first month because I hadn't seen this stuff for a while, but I knew that I wasn't going to be able to lay this whole collection out. So I just decided to depart ways with it.
You have jerseys from your playing days with the Bulls, from your time on the Dream Team, jerseys of other players, shoes from other players as well. As you sort of amassed all of this over the years, I mean, was it just kind of like, you just ended up with this stuff because, I mean, that's just how it works when you're a professional athlete, or did you have a mind of collecting and curating this stuff as you went on?
I had a mind for it. Yeah. I was a collector, I guess, to some degree of my own collection. So it was something that I valued throughout my career that, I felt one day that I was going to hang these jerseys up or be able to give them to my kids. But it came to a point where they don't want the jerseys, and I think that, I would probably keep it in a box or something for the rest of my life. So I just felt like it was time for me to move on from it. I know there's a lot of collectors out there that, enjoy and embrace these moments. So I decided to part ways with it.
So it sounds like the timing was right, and it sounds like there wasn't necessarily a hardest piece to part with. But I'm curious whether this is truly the entire collection, or did you keep something back for yourself?
I kept a lot back.
Yeah.
I probably had over 250 items, and so this is just a small portion of my collection.
Are you surprised at just how big sports memorabilia has gotten? I mean, we take an auction house like Sotheby's that's normally auctioning off Picassos and, Van Goghs or whatever. And now we've seen over the years them auctioning off memorabilia in the sports world, the entertainment world, things that in the past would not have sort of traditionally been considered to be worthy of an auction house like Sotheby's.
Well, I think sports is definitely came a long ways, definitely in terms of the value of players' jerseys, things that we've seen in the past and how they've been able to sell. I wasn't expecting this when I started my collection. Mm-hmm. It's just happened that, memorabilia is at an all-time high right now. But, I was glad that I was able to maintain and keep a lot of the stuff that I played in.
With regards to the items that you did select, and there's a great video that Sotheby's put out of you kind of going through some of the items. What was kind of like one of your biggest memories as you were going through that collection and kind of reminiscing? Was it the three-peats, the two three-peats you had with the Bulls? Was it your membership on the Dream Team, the Olympic team back in the 90s?
Well, it was a lot. Yeah. I think a lot of it was my years with the Bulls, the 90s, just a long run there, 11 years winning, the success that I had there. It was all, but it was a lot of everything. You know, the stuff that I collected during the 92 Dream Team, the stuff I collected from the 96 Dream Team. When I was in the moment, I really cherished those moments, and I collected a lot.
Your Naismith trophy is in there, your Hall of Fame trophy.
Yeah. Yes, it is in there.
Yeah.
It's just a little award that they gave me for being a part of the Basketball Hall of Fame. But I know that there are people out there that really love and idolize a lot of the sports memorabilia stuff. I've lived it, and I've kind of moved on from that part of my life.
What's interesting is that, you know, this collection, it's not just your personal items. You also have a few items from some of your teammates and also from Larry Bird as well. I believe you have a jersey from him. But you have a pair of Air Jordans that were worn by Michael Jordan during the 1992 Dream Team Olympics game. And I think that might take a lot of people by surprise. I mean, how did it come about that you have these sneakers?
Well, we was sort of closing out the gold medal game, and we was just sitting in the locker room, myself and Michael and Charles, and I just looked over, I saw Charles had jumped up and asked Michael for his jersey, so I was like, let me get those shoes.
That's
and
pretty funny.
That's it. I mean, and that's been, what, 35 years or so.
I do want to talk about the presentation of this collection as well, because I think that's pretty unique. You know, how Sotheby's has designed what I believe is a full basketball court, right? They constructed that. What's it look like? Could you play on it? I mean, how does it actually feel underfoot?
Actually, I haven't been on the court yet. I was going to go on it this morning, but I haven't. But I'm going to be meeting some of the, I guess, fans, clients later today. So I'll get a chance to see if I can still throw up a few shots.
Scottie, can I ask you about just the state of the NBA right now, too? I mean, obviously, the 90s were kind of the golden era, and that's kind of one of the big selling points of this auction. But when you look at viewership, I mean, the NBA Finals viewership peaked with your last three-peat in 98 over the Jazz. And since then, I mean, the finals that we've seen, at least over the last few years, I mean, we're tracking TV viewership that's less than half of that. When you look at what people are watching in terms of the regular season and the finals, do you think the NBA needs to do more to promote the league, or is it just a talent issue? What's going on?
I wish I had the answer to that, but you know, the game has changed tremendously. It's a different style of play. A lot of people are not as attractive to that style of play as they did in the past, but there's other things out there too that are distracting and taking away from the game of basketball. So it's not like it was in the 90s when, you know, the cell phone was not as popular. It didn't have as many apps. Well, now people are now engaged in their phones, and it takes away from what I consider the greatest game, meaning basketball, is that people don't really have to watch games anymore.
Yeah. Do you think there's maybe some growth potential internationally? I know Adam Silver in the league is trying to do more to bring in more viewership from outside the U.S.
Yeah, I mean, our game is definitely a global game. I mean, it's definitely full of a lot of international players, and I do see the game someday expanding to Europe, maybe Mexico, but it's definitely room for growth. I don't know how we fix the problem that's going on right now, but, you know, come playoff times, I think that people tend to tune in a little more, but it's just a lot more distraction going on that it's hard for people to engage in the game as they did in the 90s and early 2000s.
That was Scottie Pippen, and this is Bloomberg.